A company that lost almost $5 billion last year just became the seventh biggest business in America in a single afternoon. That's not a typo. That's SpaceX. On June 12th, Elon Musk's rocket company sold shares to the public for the first time, and it wasn't just big. It was the biggest IPO in history, more than 3 times larger than Alibaba, the previous record holder, and by the time the closing bell rang, SpaceX was worth more than Tesla. So naturally, everyone's asking the same question. Should I buy it? And I get why. Rockets are cool. Elon Musk has made early believers rich before, and missing out feels worse than losing money. But before you open your brokerage app and smash that buy button, I want to show you 3 things. Why this IPO broke every rule in the book, what the bulls and the bears are actually arguing about, and what I'd personally do with my own money if I were tempted right now. Let's start with just how abnormal this whole thing was. Most companies going public do a roadshow, so give investors a price range, and then set the final price based on demand. It's a negotiation. SpaceX skipped that entirely. Musk's team came out and said, "It's $135 a share, take it or leave it. No range, no back and forth. Just a number, stamped down like a price tag at a museum gift shop where you're not allowed to haggle." And at $135 a share, SpaceX sold off more than 555 million shares, raising $75 billion before underwriters even exercised their option to buy more. Add that in, and you're looking at roughly $86 billion raised in a single offering. For comparison, that's more money than the entire economy of countries like Ecuador or Slovakia. At that price, the company was valued at $1.77 trillion. That made it bigger than Tesla. It made it bigger than most banks, most oil companies, most countries' stock markets combined. And here's the part that should make you pause. Musk still controls more than 82% of the voting power. So, when you buy a share of SPCX, you're not really buying a vote in how the company is run. You're buying a ticket on a train where Elon Musk is the only one allowed to touch the controls. Then trading opened. The stock priced at $135, and by the end of day 1, it had already climbed to around $161, a 19% pop. The next trading day, it kept climbing, briefly pushing the company's value above $2 trillion. Over 500 million shares changed hands on day 1 alone, a volume we haven't seen since Facebook's IPO back in 2012. But here's the twist, almost nobody's talking about. Within a week, the stock had already pulled back nearly 19% from its highs. So, if you bought at the peak of the hype, you were already underwater before most people even finished watching the news coverage. This is the part that matters: volatility. This extreme isn't a glitch, it's a signal. It tells you the market itself doesn't agree on what this company is actually worth. And when Wall Street can't agree, that's usually your cue to dig deeper before you do anything with your own money. Let's be fair to the optimists first, because their argument isn't crazy. SpaceX isn't just a rocket company anymore. Back in February, Musk merged SpaceX with his AI company, xAI, into one combined entity. So, when you buy SPCX today, you're not just buying Falcon 9 launches and Starlink internet satellites. You're buying a slice of Grok, the AI model, the X platform, and the AI computing infrastructure behind it. It's part rocket company, part broadband provider, part AI lab, all bundled into a single stock. And the bulls point to something that's actually true. SpaceX has a real, measurable head start. Analysts at New Street Research, who slapped a bullish price target on the stock, argue that SpaceX has at least a 10-year lead over any competitor when it comes to reusable rocket technology. 10 years in this industry is the equivalent of a 30-year head start in almost any other business, because the barriers to entry are insane. You can't just raise some venture capital and start launching rockets next quarter. The physics doesn't care how much money you have. Musk himself has claimed the company could be doing close to $1 trillion in revenue by 2030, up from $18.7 billion last year. That's not a typo either. He's talking about a roughly 50 times increase in revenue inside 4 years. If even a fraction of that materializes, today's price could look cheap in hindsight. the same way Amazon's early valuation looks cheap-looking backward 30 years later. So that's the bull case in one sentence. You're not buying what SpaceX is today. You're buying what its founder believes it becomes if Starlink scales globally, Starship makes space travel routine, and the AI division becomes a real competitor to OpenAI and Anthropic. That's the dream. Now, let's look at the part that should worry you. Here's the number that should stop you in your tracks. SpaceX is trading at over 100 times its revenue. To put that into perspective, even the most hyped-up AI companies on the planet, the ones everyone already calls overvalued, typically trade between 20 and 40 times revenue. SpaceX blew past that and kept climbing. And remember, this is a company that posted an operating loss of $4.2 billion and lost almost $5 billion overall last year. Its capital spending is also exploding. In the first 3 months of this year alone, it spent over $10 billion, more than double what it spent in the same period the year before, with most of that money pouring into AI infrastructure, not rockets. This is exactly the kind of setup value investors hate. You're being asked to pay an enormous premium today, based entirely on a story about tomorrow from a company that's currently burning cash at a historic pace. And the analysts are genuinely split on this, which almost never happens with a company this size. CFRA initiated coverage with a sell rating and a price target of $115, nearly 30% below where the stock peaked. Morningstar went even further, valuing the actual business at just $63 a share, less than half the IPO price, and explicitly called it overvalued. Meanwhile, on the other side, Areta Research slapped a $401 price target on it. That's not a small disagreement. That's analysts looking at the exact same company and landing on numbers nearly 7 times apart from each other. When the spread between the bulls and the bears is that wide, it tells you nobody actually knows, including the professionals whose entire job is knowing. There's also the Musk factor. You're not just betting on SpaceX. You're betting on one person's attention because that same person is simultaneously running Tesla, X, and XAI. History has shown that when Musk's focus shifts, the company he's not focusing on tends to feel it. Just ask Tesla shareholders who lived through the periods when Twitter, now X, was eating up his bandwidth. So, strip away the excitement. And here's the honest summary. You're paying a historic premium for a company burning historic amounts of cash, controlled entirely by one person, with professional analysts who can't agree if it's worth $63 or $401 a share. So, should you actually buy it? I'm not a financial advisor, and I'm not going to tell you what to do with your money. But here's the framework I'd personally use if I were tempted to buy SPCX right now. First, separate excitement from evidence. Wanting to own a piece of something cool isn't the same as it being a good investment. Plenty of exciting companies have made early investors broke, and plenty of boring companies have made people rich, slowly and quietly. Ask yourself honestly, am I buying this because of the business or because of the launch footage? Second, treat this as a speculative position, not a core holding. If SpaceX belongs anywhere in a portfolio right now, it belongs in the same bucket as a small bet on an early-stage idea, not the same bucket as your retirement index fund. A reasonable approach is deciding on a small percentage of your overall portfolio you're comfortable potentially losing entirely, and never going past that number, no matter how good the next headline sounds. Third, respect the lockup. Most company insiders and early investors are usually restricted from selling their shares for a set period after an IPO, often around 6 months. When that lockup expires, a wave of new selling can hit the stock as insiders cash out. And that's historically when a lot of hyped IPOs see their sharpest pullbacks. If you're going to buy in, understand that date and what it could mean for the stock. Fourth, zoom out further than the headlines want you to. The bullish analysts aren't valuing this as a 1-year trade. They're valuing it as a 20-year bet on humanity actually becoming a multi-planetary species with AI woven through everything along the way. If your time horizon is a few months, you're playing a completely different game than the bulls are, and you should size your bet accordingly. Here's the truth. Nobody wants to say out loud, this isn't really a stock pick anymore. It's a referendum on how much you believe one person's vision of the future, wrapped in one of the most volatile, most expensive, least transparent IPOs we've seen in years. If you believe in that future enough to stomach a 19% swing in either direction before lunch, that's your call to make. Just make it with your eyes open, not because everyone else is talking about it. If you want to understand what salary you actually need just to live a normal life in 2026 without constantly feeling broke, I'll leave that video right up there. But don't click on it just yet. Make sure you're subscribed if you want to keep seeing breakdowns like this one, because this story isn't close to over. All right? I'll catch you in the next one.